Hey everyone, welcome back to Corporate Decoder. Today we're diving into the Credit Suisse High Yield Bond Fund's semi-annual report. Get ready, because with high yield bonds, it's kind of like ordering the spiciest dish on the menu. You hope you can handle the heat. This report covers the 6 months from November of 2024 through April of 2025, and it gives you the lowdown on how the fund performed, what investments it held, and what the managers think about the future. We're going to break it all down into plain English so you can understand what's really going on. If this analysis is valuable, hitting that like button really helps, and be sure to subscribe for more deep dives. Don't forget to check out the Discord in the description. AFIs are really going on. If this analysis is valuable, hitting that like button really helps, and be sure to subscribe for more deep dives. Don't forget to check out the Discord in the description. First up, the Investment Advisor's Report. In simple terms, this is a letter from the people managing the fund to the shareholders, so that's you, explaining how things went and what they expect moving forward. Let's start with performance. The report mentions something called total return based on net asset value, or NAV. Basically, NVV is what your shares are actually worth, ignoring fluctuations on the market. The fund returned 0.63% based on NAV. Unfortunately for investors, the total return based on the market value, or what investors are willing to pay, was actually negative, at 0.6% NIV. Unfortunately for investors, the total return based on the market value, or what investors are willing to pay, was actually negative at 0.90%. The goal with these funds is to outperform some kind of industry index, and this fund did not meet that goal. The ICE-BofA US High Yield Constrained Index, which the fund is benchmarked against, gained 1.70% during the same period. The report spins this as a positive period for high yield assets despite some volatility. And, corporate reports, if no one gets hurt, it's spun as at least a partial win. They were partially correct thanks to coupon income. Coupon incomes refers to the literal coupons the bonds have tied to them, which equal 3.3% returns. However, that gain was wiped out by the price of bonds declining 1.6%, meaning investors thought had less faith in the future. This all led to credit spread widening, meaning the difference between rates paid by safe investments to higher risk investments widened due to investor skittishness and reduced business conditions. However, that gain was wiped out by the price of bonds declining 1.6%, meaning investors thought had less faith in the future. This all led to credit spread widening, meaning the difference between rates paid by safe investments to higher risk investments widened due to investor skittishness and reduced business conditions. Speaking of risk, the report says BB-rated bonds outperformed the index with a 2.1% gain. Lower rated bonds graded either B or CCC didn't do so well, only getting 1.5% or 0.4% respectively. The investment advisor continues talking about their outlook, focusing on bankruptcies and default actions. According to JP Morgan, they write the default rate ended the period at 1.2024. So that sounds pretty good. Finally, we have their actual outlook for the future, in which they write how they actually did the good, the bad, and the ugly. Apparently, investment into bank loans detracted from relative returns, while collateralized loan obligations actually added to returns. At the end, they end with cautious optimism. All of these insights were provided by John Pop and Omar Tariq. Those named are Chief Investment Officer and Chief Executive Officer and President, respectively. All right, that's all of those guys' summary. So what did the bond holdings actually look like? Let's scroll down to the report that actually describes what the fund is holding. So this is the part of a portfolio that the average investor will see. You see all the corporate bonds arranged by sector. They hold bonds from Aresco Isua LLC, Amentum Holdings, and Bombardier Inc. Pretty standard companies you'd expect from high yield bonds. This area constitutes 100 bonds. Area constitutes 1843 Ams annual welcome back. After that large portion of bonds, there's another section which describes holdings of air transportation companies such as Stonepeak Nile Parent LLC and VistaJet Malta Finance PLC. This area constitutes almost 1% of the portfolio. Following that air travel, there's more standard things such as auto parts, brokerages, building and construction. There's really nothing too interesting here other than the names of companies you'd expect. Next time you're driving your car or ordering some furniture, just know there's a chance that part of your debt is being wrapped up in a highly leveraged debt market. Kind of scary, no? Here you see a whole bunch of bank loans, meaning money lent directly to companies. These loans are often riskier because they might not have easy to sell in the market. The biggest sector is media, diversified, and software services, among others. This section seems like just a bunch of banks making loans to each small and medium-sized media company, all bundled up nice and neat. This section of the document is 21.3% of what they own. Also, shout out to the writer of banks making loans to each small and medium-sized media company, all bundled up nice and neat. This section of the document is 21.3% of what they own. Also, shout out to the writer of this report because some of the loan and equity valuations from two companies, PS Holdings for their loans and PES Energy for their common stock, are literally less than $1,000. Talk about squeezing out every bit of value, huh? Collateralized loan obligations make up around 8% of what they own, basically more debt bundled up and sold out. This looks pretty standard. Moving on, there's stock section, in which there is a lot of chemicals, hotels, equipment in common stock and warrants. There's less than 1% of owned portfolio. Finally, short-term investment make up the other 8.2% in the State Street institutional US government money market, whatever that is. Last but not least is the unrealized losses with the forward. So the company seems to be banking on some future sales that didn't look good. So in total, it's a loss around 141,000. This is opposed to the appreciation from the first part, which is only around 25,000. To get everything straight, the report finally totals everything all together. CADS, the fund has about 103 million outstanding shares and a net asset value of about $221 million. The key stats they report were that net investment income totaled $8.9 million, but that was virtually wiped out by the loss of $6.7 million from investments so far. So pulling back from the numbers and looking at the bigger picture, here's what I see. Strengths: the fund's historical outperformance and the portfolio managers seem to have done a good job despite a rough half year. And its weakness: slightly too leveraged. Because of that, the returns are extra volatile. This fund relies heavily on the economic cycle to continue growing. There is nothing particularly special or different about their portfolio. Proceed cautiously, but given their track record, the leadership seems capable. That's our breakdown of the Credit Suisse High Yield Bond Fund's semi-annual report. What do you think about these numbers and the fund's strategy? Share your thoughts in the comments. If you found this analysis helpful, hit that like button and subscribe for more of these deep dives. Also, join our Discord community linked in the description for even more discussion. Thanks for watching and see you next time.